Now, Ray Dalio says you'd have to be quite mad to keep bonds at the moment or buy bonds. And what's interesting is this is very different to the advice of two other investing titans. In terms of Warren Buffett says you should have 90% in the S&P or similar stock markets and 10% in short-term government bonds, whereas Jack Bogle, the founder of Vanguard, says your bonds should be linked to your age. In other words, when you're young, you might want to have 100% in stock markets, then 90%, then 80%. But basically, you should follow a bonds to age strategy. In other words, if you're 30, maybe approximately 30% in bonds. If you're close to retirement, maybe 50% in bonds, and in retirement, 50% in bonds. But if you're 20, maybe you could have 10 or 20% in bonds. Who do I think is right? Now, what's interesting is I actually think that Buffett's opinion is probably going to be proven right long term, with one caveat. I do think it's important when you're close to retirement to have more bonds. Now, what do I mean by that? Bonds aren't sexy, it's true. Bonds do not pay a lot of money. But short-term government bonds in 2008, in this crisis, outperform. And for that matter, if there's ever a period where stock markets have a decade of underperformance, bonds outperform. So for example, from 2000 until 2010, that was a lost decade for US stock markets. So bonds actually perform better, especially in the early 2000s after the NASDAQ crisis. Again, bonds performed very well, which obviously made sure that a buy and hold and rebalance investor could have just rebalanced from one to the other. However, what is true is an 100% stock market portfolio will probably beat a bond portfolio long term. But in the last 20 years, somebody who is 70% in bonds and 70% in stocks and 30% in bonds actually got almost as good investment returns as somebody who's 100% in stocks, assuming they rebalanced when markets went down. So for example, let's say in 2020, a couple of months ago, let's say somebody had $1 million in their account, 600,000 in stocks, 400,000 in bonds. Of course, the bonds went up, at least short-term government bonds, not medium-term bonds, but short-term government bonds went up, stocks went down, so you could rebalance from one to the other. So don't neglect bonds. They might not be sexy, but don't forget that they add diversification to a portfolio. However, I do think that if you're too conservative, too young, it will affect your performance long term. So in the 70s or 80s, or hell, even the 90s, maybe it wasn't such a big deal to have 30% bonds if you're 30, or 35% bonds if you're 35. In fact, if you go back to the 80s, I think you could make like 10, 15% in government bonds. Why wouldn't you want a reasonable proportion in bonds? However, I think these days bonds pay so little that even though they give a great rebalancing opportunity when markets are down, you have to factor in they don't pay much. They pay more than cash, so that's great, but they don't pay very much in normal years. They only tend to go up when stocks have had a big fall. So therefore, I do think keeping about 10% in bonds and then maybe gradually, very slowly increasing so that maybe you've got 20%, and then of course near retirement have 40 or 50% in bonds, like 3 to 5 years before retirement. That makes sense. But having too much in bonds doesn't make sense. But where I do disagree with what Dalio is saying is I don't think it's realistic that people are going to just move away from the USD. In terms of in 2008, the USD stayed very stable. In fact, went up in value even though the US central bank was doing QE, 0% interest rates and so on. So in an uncertain world, it doesn't really matter how much the central bank intervenes. I think it's very unlikely that there's going to be any kind of currency run against the USD. So I don't think what's happening in terms of interest rates will necessarily, and also QE, affect bonds as much as Dalio is assuming. But what I do think is likely, and Buffett's also made this point time and time again, is that when you've got bonds paying so little, any long-term investor is almost for sure going to make more in the stock market compared to the bond market, as long as they can take the volatility that comes along with that. So my advice would be 90 to 100% in stocks when you're young, then gradually increase. Maybe in your 40s, you could go up to maybe 15, 20%, and then dramatically increase before retirement, but have two stages. The accumulation phase, where you're just trying to accumulate units. And even if stocks go down or up, just keep accumulating, and it'll be fine even if markets are going down for a few years. But then have a preservation stage where basically you're trying to preserve what you do. In other words, if you start investing from your 20s or 30s and you keep investing for decades, you should do fine. But then it comes to a time when you have to take a bit of risk off the table just before retirement. So having that two-stage process would make sense, but you will have to accept quite a lot of volatility for that. If you're new to investing and you're afraid of volatility, which you shouldn't be, as per my video on the NASDAQ, you might want to go 50% bonds, 50% stocks, just because it'll be easier on your nerves, because it won't be as volatile. But bear in mind, if you have a lot of bonds, it will affect your investment performance long term.